Good evening, ladies and gentlemen. This is Barry Norman, and welcome to our class on retracements and reversals. Now, tonight's class is sponsored by ADS Securities with their Prime website, and they are the sponsors of our class tonight. They are one of the world's leading providers of online trading with unequaled service, support, education, and the most advanced trading you can find in the marketplace. They are a regulated provider, so you know you're safe and secure when you trade with Prime. They are part of the compensation scheme, so you never have to worry about your funds, and you never have to worry about liquidity or transactions because you know everything is conducted under regulation and being monitored by regulators at all times. They offer trading in indices, currencies, commodities, shares, metals, and treasury bonds. You can trade just about anything, any which way you would like when you trade with ADS. Now, tonight's class is on retracements and reversals. And I'm going to apologize now because I'm in a what's the word, a shortage, not a shortage. I'm in a weak position because our internet and our electricity is out. We don't know how long it's going to take to fix it, so I'm actually using my laptop when I usually do this with two monitors in a great big computerized room, and I am using the battery on my laptop, and I'm connected to the internet from the restaurant across the street where they still have power. So you'll have to bear with me. I'm apologizing ahead of time, but we'll be all right. We'll get it all done. Now, reversals and retracements are very important to know because they will help a trader make the most of in profit or warn them to get out of the markets. Because too many traders panic when they start to see a trade moving against them. But this is common. The markets do not move straight up. They move in thrust and ease, thrust and ease, thrust and ease. And you have to be able to spot whether you're looking at a retracement or a true reversal. Because if you're looking at a reversal, it's telling you to get out of the market. If you're looking at a retracement, well, if you get out of the market, you still probably made profit, but you didn't maximize your profits. And what happens, you end up leaving the market when you could have stayed in there and even rode it for another 20, 30, 50 points. And the fact is you need to maximize your profits or your profit loss ratio so you have enough profit eventually to offset any losing trades you have. So this is why we focus in today's webinars to provide you the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. Now, there are some sets of rules, okay? But first we have to understand or define what these are. What is a reversal and what is a retracement? So a retracement is a momentary reversal that often occurs during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. In other words, when price is moving up, we would expect it to ease down a little bit as buyers reposition themselves to move back up and thrust. And there are some rules about how low the low can dip when it is dipping down so that you know it is a retracement and not a reversal, because if it breaks the low, ladies and gentlemen, I appreciate you all saying hello to me, okay? But you know, as I explained, I'm on a very tiny little monitor tonight, and all of your comments, when you're just saying hello, how are you, sir, thank you, sir, the fact is we're filling up my screen. And tonight I need you to bear with me a little bit because of the shortfalls here. So just bear with me, and I appreciate you all. So welcome and hello to all of you, and thank you very much for your well wishes. I do appreciate them. Now, a retracement has rules that it follows. Okay. because if you notice, you have these lows that are hit during retracements. Each one of these lows cannot be below the previous low. Okay. Now, we'll get to the rules as we come on, but this is why these are perfect retracements, because we see the asset push up and thrust, ease back down, push up and thrust, ease down, push up and thrust, ease down, and push up again. And this is how a trend line should look. Okay. Now, reversals, on the other hand, are temporary changes in an asset's trend that occur over a short period of time. Often these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing. When with your charting solution, reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset price's action, like seen with a retracement. In the picture below, you can see the example of a reversal, and I'll show it to you better in a second. But it is all about how you react to these. So the question is an investor to know whether a stock or an asset is merely retracing against an existing trend, or if the trend is an outright reverse? Successful investing is predicting on knowing the answer to that question. So let's look at charts and let's take a look at them. So now I've got this chart set up for you. Okay. And there are certain rules, okay, that in order to qualify or understand what's happening, it has to fit these patterns. So a retracement, and let's talk about retracement first. A retracement is usually the profit taking by traders who entered the market a while ago. So they trade, a trader entered the market, say hypothetically at the euro at 110. He put his take profit point at 112. So when that asset pushes up to that 112, he triggers his sell. He's taking his profit, because in his trading scenario that he did whenever he entered the market, he said 112 is ample profit for me and I'm going to take my profit at that. So you have lots of small traders taking their profit. And you see this little bit of ease. So you have to look at volume. When you see price easing down, are you seeing traders run out of the market, or are you seeing a decline, a slight decline in volume? Now, when you have a retracement, there are fewer any reversal patterns. Usually they're limited to candles, because nobody can really tell you this while it is taking place. Now, the time frame involved is short-term reversals last no longer than if you're looking at a one-day chart, 1 to 2 weeks, because they don't happen. Now, most of us are short-term traders. We're trading to get in and out of the market in one day. So you have to apply that. How long do you expect a reversal when you've entered the euro this morning and you want to be out by the end of the day? You're a day trader, or you want to be out within 2 days or within 3 days. So you have to figure out how long you would allow this dip before it's confirmed a reversal. Also, it's very important, when you have a retracement, there are no change in the fundamentals. Means there's not any news headlines that came out there. There's not any economic reports. It's just the buyers easing back, or the sellers, depending on which way you're going, easing out of the market. And you will actually see this. It usually occurs after large or significant gains. In other words, the market thrust up in an uptrend, and so you saw significant gains, and then the market is easing back down, and then it will start to thrust again. So the buyers get tired out, or the buyers have bought up all they can. The sellers are selling a little bit to make their profit, and the buyers are refreshing themselves. It's taking a break. Okay, and candlesticks will a lot of times show you spinning tops, or they'll show you dojis, because there's a lot of indecisiveness in the marketplace at that point. The buyers and sellers are trying to, the buyers get tired in an uptrend. The sellers are trying to see whether they can, is it going to be turned a downtrend? And nobody's sure for those few minutes. So what you're seeing is, in your candlestick patterns, you're seeing candlesticks that tell you indecision. Now, for a reversal to start occurring, you'll see large blocks of sellers. So you see a big change in volume. Okay, you'll see very little buying interest. There's nobody buying. They're all selling, or the reverse in a market. You might see double tops and double bottoms. In other words, because as the price moved up and then it fell back down, then it tried to move back up a little bit and fell back down, it formed that double bottom again because the buyers are not able to generate the momentum to push it back into the uptrend. Again, depending on the time frame you're trading, you don't want to have longer term reversals, anything lasting longer than a couple weeks. Okay. And with your candlestick patterns, engulfing candlestick soldiers and other similar patterns, which are hardcore reversal patterns. Now, whenever a price reverses, most traders and investors are faced with a tough decision. And you have three options. One is to hold throughout the sell-off, which could result in large losses if the retracement turns out to be a larger trend reversal. Okay. Most of us in a large in a reversal or a retracement, a lot of us can't afford to float or can't afford to put our stop losses down low enough to offset this. Or, we entered the euro at 111. It pushed to 112 and now it's dipped down to 110.59. It's going to, and it's going to go back up, but we can't afford the losses. So the question is, can you hold throughout the sell-off? Two, can you sell and rebuy when the price recovers? Which is definitely the result of money wasted on commissions and spreads. And this is the problem. A lot of people say, well, when it starts to go and I can't tell whether it's a retracement or a reversal, I should just get out of the market. Well, that could be true, but you get out of the market with just a few pips. And what point do you get out of markets? Nobody can tell you when that reversal or retracement is occurring. And then you want to get back in that market because the market starts to soar back up. But you lose the spread and sometimes the commission of having to exit the market and then enter the market. So you have a double trade, and then you probably can't get in there as quickly. And what happens is even the trading formula you use, because you've got, remember, risk management and money management are the ultimate determination factors when you make a trade. And if you're using a 3-to-1 ratio, you know that that asset has to move up 3 times of what your potential loss was for you to exit that, to be in that trade. Okay, a 3-to-1 win-loss profit-loss ratio is a good ratio. Now, to re-enter that market after that, you've determined that was just a simple retracement, you may not be able to see that 3-to-1 reward again. So what happened was you got out of that market, but if you had sat tight, you could have made another 50 pips or 40 pips or 30 pips. But by the time you re-enter the market, cover the spread, cover the commission, it's basically when you sell out of a market, it's over with. You move elsewhere. Or you can sell permanently, which can result in the loss of missed opportunity if the price recovers. By properly identifying the movement as either a retracement or a reversal, you can reduce costs and limit loss and increase gains. So this is a determination you have to make, okay, what you're going to do. Now, traders have an expression for attempting to pick a market top or bottom, and they call it trying to catch a falling knife. As this expression implies, it can be downright dangerous and is not normally recommended. But here is a method that may help lower the risk. Now, retracements are healthy. The market needs to see retracements because no asset is going to move straight up. Because sure, yesterday when the Feds came out, you saw the asset soar, but what happened with the Fed? Dollar soared up, came back down, and the euro dollar soared up, came back down. That wasn't a retracement. That was just a fundamentals change. Okay, retracements are healthy. A good trend, a solid, strong trend, like I said, moves in thrust and eases, thrust and ease. Now, each time the price thrusts up, when it dips down to the new low should never be lower than the previous low. So if it starts dipping lower than that low, so in other words here, price moved up, it eased back down. If this ease comes down here, you want to be out of the market because that is not a retracement. A retracement, because then you want to push back up, and then your next ease will come back down here, and it will fall below this one. And what it allows you to do also is to continue moving your stop losses up so that you've got profit blocked in. So the market in general can become tired of moving in the same direction. So think of it. You're running and running and running and running. You just, you want to turn left for a little bit instead of, or change your track for a minute. Or you just get tired out. You need to take a breather. Okay. It takes a lot of work and money to send assets to higher highs. Now remember, when a price is moving up in an uptrend, it's continually making higher highs, new highs. When the price gets too high, buying pressure runs out when the money dries up. When the demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to prospective buyers because a buyer who's sitting on the sideline, okay, you entered here, you wrote it up to here. This buyer who's done his analysis doesn't want to enter here. Okay, so he's sitting on the sidelines, but when it dips down, it becomes more attractive. So he starts re-entering the market again, and he helps make the next push. As the price becomes more appealing at a lower point, these new buyers step in, creating demand, and once again, the price begins a leg higher. What I have just described is a retracement. Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on a trending stock. So in other words, you don't want to ever enter here, here, or here. If you're a trader, what you're looking for is this dip in a solid trend. Now, you're not going to hit the bottom, but when it starts to bounce back up, this is the entry points. Okay, when you're going to enter the markets is when you're coming off of a retracement. In a strong trend, the problem is too many people get in here or here or here. See, if you got in here, okay, the market rides up. When it dips down for its retracement, it still hasn't fallen below. You're still in profit. Okay, the next guy wants to get in here or here, so when it pushes up, and then it eases back down, he stays in profit. Okay, so you're never, if it's done properly, you are not losing your money. You're losing some of your profit, but you're not losing your investment. Okay. Now, you can see that after retracement, the healthy part of a trend line, let me get my markings off here. Sorry about that. You can see that after the retracement, the asset was able to push to a higher high. So this is the continuation of that. It retraced down here, it pushed to a new higher high, but it wasn't higher than the high that it made before. Okay, so instead of a security rolled over and created a lower high is unhealthy. So what happened was here, when it couldn't go above, when it started to recover from that retracement, and it couldn't go above the high that it made, wasn't higher than its initial high, it's telling you the market is in trouble, and this becomes the sign of a reversal. Okay. It's possible that after setting lower highs, the stock could retrace again, but never setting a lower low, and then push above the previous high to a higher high. The nail in the coffin of a bullish trend is the establishment of a lower low. Okay. Once the lower price is your place, your trend is over, and this is called a reversal. Because remember, let me get my markings up here and go to a chart for you. when price is moving up and you put your trend line on a chart, whenever price breaks below that trend line is ended. So you want to see thrust, ease. So what happens is ease cannot be below the trend line, so therefore it can't be below the previous low here. It pushes up, it eases back down, it still can't come below that trend line, pushes up, eases back down, pushes up. So in other words, it has to make a higher low each time. If it makes a lower low, it's broken that trend line and your trend is over. When your trend ends, you know the price trend is over. Okay, so reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. Okay, so what should you do? When faced with a possible retracement or reversal, you have three options. Okay. Now, if you are in a position already, you could hold on to your position. This could lead to losses if the retracement turns out to be a longer term reversal. And this is what becomes important. You have to, and this is why you need to enter the market when that retracement has started to move back into that uptrend, so that when it moves up and then retraces, because that retracement cannot fall below the previous low. And if you enter to that previous low, at least when it does, you exit the market, and hopefully you at least leave the market at a break-even scenario. Because once it's fallen below where you entered it, and you entered it properly at the bottom of that reversal or the bottom of that retracement, okay, you're now in a reversal. So you want to be out of that market. So it's crucial that you enter the market at the right time. Too many traders see, oh, look at that. That asset's moving up. It's time to enter the market. I'm going to buy. And they buy 2/3 up or 1/3 up of that leg. And then when the market retraces, they can't hold out for that retracement, that full retracement, to see whether it's a retracement or reversal, because they bought too high. And now they're in loss. And they've got their stop loss placed down because they can only afford to lose so many dollars. And you get stopped out. So it is so crucial to enter the market at the right time, not exiting the market, but entering, because if you entered it when the retracement had verified and bounced off the trend and bounced off the lower low and started to make the new highs, then you could have ridden it up to the top. And then if it goes into that retracement, depends on how steep that retracement is, but when it comes down to where you are and you entered the right point, that means it is now breaking that trend line. So you know you're in a reversal. So you could close your position and re-enter if the price starts moving with the overall trend again. So this is one objective. You know, if you enter the market, whether you entered the right point or too high, when it starts to dip down and you're not sure whether it's a retracement, you could just close your position. Okay. Now, of course, there could be a missed trading opportunity if the price moves sharply on one direction. Money is also wasted on spreads and if you decide to re-enter. But you could, last choice, permanently close your position and move on. You made money. But be prepared, because reversals can happen at any time. And that's the thing. Retracements can become reversals, and retracements can happen at any time. Even though you have a trend moving up, there is no rule of when that ease is going to happen. Now, lots of people say, and you have Elliott wave patterns that tells you each leg of that wave up, you know, wave one should be this long compared to wave two that's that long. There are trading methods that will tell you each of these legs and using numeric equations, but there's no guarantees. Okay. Now, there are some popular tools that you can use with these that will help you. And this is why Fibonacci retracement levels are so crucially important, because they help you see that when a market is retracing, okay, if it's coming down to the 38.2, the 50 or the 61.8 to bounce off, each of those are crucial levels in a Fibonacci, and will help you determine whether you're actually in a retracement or a full reversal. And will also help you figure out where to bounce and enter the market at the bottom of that retracement. You also have pivot points for support and resistance. You have trendline support and resistance level. And then, of course, there's a lot of chart patterns. Triangles are a great way to help. Okay, candlesticks have very good ones. But Fibonacci retracements are excellent tools for calculating the scope of a retracement. They are most widely used in the foreign exchange market, but are also used in the stock market. And simply use the Fibonacci tool, and it's available on every charting system to draw a line on the top and the bottom of the latest impulse wave. And these impulse waves, if you don't know what they come from Elliott waves and impulse waves, and this is the rule that the market moves in a 5-leg cycle up, then a 3-leg cycle down, and a 5-leg cycle back up again. Now, Fibonacci retracements are excellent tools for calculating the scope of the retracement. Okay. Now, in most cases, retracements will stay above the 38.5 level. So in other words, we saw the market here. We saw the market here, and we saw it push up to this level. Okay. Now we're looking for a retracement or an ease or a reversal. The market tested down, and we're looking at where it's going to bounce back up, or is it going to fall into a full reversal. Now, we have not ever come down to this lowest low here. Okay, we're not even half of the overall move. And if we use Fibonacci levels on there, and you simply take your Fibonacci tool and you pull it from the low to the high, and then it will give you the Fibonacci levels. So we have the 38.2, the 23.6, the all-important 50, and the 61.8. So we saw that when price moved up, okay, we put our Fibonacci, and it came right through the 23 down to 38.2, hit the 50 level, bounced off the 50 level, but it was not able to make a higher high. This is the point we're going to get a little bit worried. Okay. But since if we entered correctly, we entered somewhere in this area, we're still in profit. We see it dipping back down, and at this 50 level of Fibonacci, we're really starting to worry. And if it hits 61.8, we're really starting to worry, should we get out of the market? Well, we saw it bounce off of here, okay, come back down, and then we saw it hit this level, the 50 level, and then take off. Now, the point is, too many traders enter here, okay, are still in the market. Let me just get these off of here. Enter the market somewhere here, okay, and you're not going to catch that high. Now, if you put your stop loss, your take profit at that proper level, but you probably didn't. You probably put your take profit level somewhere around here, okay? Because this is not the overall movement of the trend. This is just an ease in the trend. So what happens by the time you start worrying, is this a retracement or a reversal, you're somewhere in this level. So you entered here and you're somewhere about here. You've made very little pips. So you're trying to say, do I stay in the market or do I exit the market? Too many traders panic and they exit the market. And even if they stay back in, they might sell here when it starts to dip back down. Okay. Down at this level, they panic again. Okay, and they trade out. The fact is, you need to be able to ride these out because nothing's giving you a clear reversal signal, because you want to be able to stay in here, because you see here the price was able to eventually break and cut you a new high, and once it did, that tells you the asset had a lot of momentum. And if you would have made this trade, you would have made a few pips, but not enough to have been in the market. If you would have made this trade and been able to stay to where you had originally said you set your target point, and you had entered here, you made a nice little trade. And this is it. It's entering the market at the right point and staying in the market long enough, because too many people run. Okay. And if you cannot afford to put your stop losses low enough or far enough away that you can ride out the markets. Now, what you could have been doing here is you entered the market here, okay, when it topped out here and you were able to put your Fibonacci levels, you could have said, okay, you know what, I'm going to move my price up to the this level, the Fibonacci level, okay, to just move my stop loss up a little, move my price point and my stop loss up a little bit farther, because that way you've already locked in a little bit of trade. So if the market does go in a true reversal, you get stopped out of the market, but you actually get stopped out with a little bit of profit. Now, guys, I've explained to you very, very carefully that I am very limited tonight, okay? I am using a tiny little 13-inch laptop screen, so I cannot help you with these 97-word questions. Okay, and I'm just going to continue ignoring them because they cover my entire screen, and I just can't help you. I asked you in the very beginning, please bear in mind that I have no power. I'm using a laptop on a battery and a faraway internet extension across the street. So I understand. But you know what? I can't stop to answer, and I can't even stop to read these great big long questions. So if the question comes in as more than 10 words, I'm just going to stop looking at it anyway. Okay. Now, another way that you can combine together to determine what levels you might want to look at is using pivot points. Pivot points are a way of calculating support and resistance. And pivot points come off of pivot point chart, and they will give you support and resistance levels, and they'll give you 3 levels down and 3 levels up, so that when price is moving, you can see whether it's broken above a support level and then ease back down, and it's still staying above the resistance level. Okay, so here we're in a downtrend, so we came down. So here we have our resistance levels. And if you don't understand what support and resistance levels are, you need to learn what they are. They're crucially important. And right after this class, I do have a class on support and resistance. Okay. Now, these are already put on your price charts. These are calculated by your pivot point calculator, and you've drawn these on. So we saw price move above this resistance line. Resistance is where the price has to break through if it's going up. Or if it's coming down, it's just the opposite. So in this case, we were in a downtrend, and this was the resistance. It was stopping the price from falling any farther. It resisted the farther decline. Bounced off of there, came up here, came back down to that resistance level. Now it broke through. It came back down to its next support level and bounced off of there. Okay. Now, there are lots of complicated ways to use these, and support and resistance is crucial. But they're also very important in determining whether it's a reversal or whether it is a retracement. Because when the price is easing and it falls below your support level, or the reverse in a downtrend, then you need to start worrying, and you need to look at the next resistance level. If you combine those with Fibonacci support and resistance levels and trend lines, you might be able to understand what is happening. Okay, you might be able to say, uh-oh, I need to be out of this asset. Okay, now this is not a very good example. I mean, it's a very good example of support and resistance, but because to me, there was no tradable trade on this entire chart. Okay, because you don't have any good uptrend or downtrend. You have lots of short-term uptrends and downtrends, but nothing in a longer-term trend. Okay. Now, somebody asked, how do you determine entry points? Well, that's all based on the strategy you're using. But what you should be doing is when you're looking at an asset moving up, if you combine that with support and resistance, that asset's moving up, it's going to touch that resistance level, and it's either going to break through it or bounce off of it. Most likely it's going to touch it and bounce off of it, but it's eventually going to go through it. If it's also coming off of that retracement, that is a very good entry point, because that's when that ease has finished, and now you want to be in that market so that you can ride it up to the next wave, because you want to be in there at the beginning. So trend lines are also very, very crucial and very critical and very important to determine lots of things, entry and exit points, support and resistance, but also whether you're looking at a reversal or a retracement, because a reversal will break the support trend line. So in other words, when price is moving up and doing the thrusts and knees we talked about, if you understand the higher highs and the lower lows, okay, it can never make a low lower than this low, or then in this case this low. Okay, so therefore what would happen is, if it did, it would have actually broken this trend line, and all of a sudden your trend line is over, so therefore your whole chart pattern is over. Okay, because a trend line gets invalidated the minute it is broken. So if you notice, this was the original low that the support line was. So that is your low. Then it pushed up and it eased back down. This created your next low in your ease. Then it pushed back up. Now it can have all of these things in the middle of a trend line. Now it came back and touched that trend line and bounced off of it again. This creates your next low. At no point in the future can it break below that low, because what happens is what it did. It breaks in order to get lower than the previous low, it has to break the trend line. So that means that that trend is over. So therefore, you know you've moved to a reversal. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversals. Now, chart patterns are very helpful at this, and one of the most helpful are head and shoulders. Now, chart patterns, or double tops, double bottoms, triple tops, triple bottoms, chart patterns have an established definition and criteria, but there are no patterns that tell you with 100% certainty where a security is headed. After all, the richest man in the world would be a trader in the case rather than an investor. The process of identifying chart patterns based on these criteria are subjective in nature, which is why charting is often seen as an art more than a science. Okay, but a head and shoulders pattern, okay, a triple top, a triple bottom, okay, are very good ways to predict whether you're looking at reversals, because chart patterns have very specific rules. Also, when you're looking at triangles, symmetrical triangles, when price is moving into that center of a symmetrical triangle, and it can break out upward and continue the trend, or if it breaks out downward, it is most likely moving to a reversal. So the most popular chart patterns are reversals and continuations. A reversal pattern signals that the prior trend will reverse upon completion of the pattern, while a continuation pattern, okay, which means it's going to continue back to that trend, which is a confirmation of a retracement, will signals that a trend will continue once the pattern is complete. These patterns can be found across any time frame. Okay, now we have whole classes in chart pattern. We have whole classes in triangles. There's a whole bunch of mathematical calculations on how to use a triangle, all based on the width of this triangle to determine when it breaks out, because when it breaks out of a triangle, it's going to have, the asset will have momentum to carry it in that direction. So in this case, we were looking at, we're looking to see which way the breakout is. Breakout is when it leaves the triangle. When it breaks out that triangle, you can calculate the momentum it will have. So just imagine that you have all of this stuff, all these traders being pushed into this little area. Sooner or later, the bulls or the bears are going to burst out. When they do, they burst out with a known momentum. Okay. Now traders will enter, and now you have to, if you come to that class, then we'll teach you, because it's also a great way to calculate entry and exit points. Traders will enter into a long position on the break above resistance, okay, which is the top of a triangle, where traders will enter in a short position on a break below the support line, which is the support line of the congestion in a triangle. Okay. Now remember, technical analysis, the study of historical price performance in an effort to predict future price performance, or chart patterns. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least and possibly a more important determination of price than fundamental factors like earning revenues and profits. So market sentiment and volume can help you, because when you see a relationship to sentiment predictors as well as volume increasing or decreasing, you can tell what all the other traders are doing. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental change. And third, the relationship between price and time is linear. This is why the stock price moves can be viewed as patterns on charts. Different strategies have varying degrees of success depending on where the market is in a bigger time frame. Now, triangles, like I said earlier, is one of the most popular ways to forecast price movement, and whether you are in a confirmed uptrend or whether you're looking at a reversal or you're looking at a retracement. Triangles are among the most popular chart patterns used in technical analysis since they occur frequently compared to other patterns. The most common types of triangles are symmetrical, ascending, and descending triangles. These chart patterns can last anywhere from a couple weeks to a couple months. Now, if you want to see one of these in real action, gold is in a beautiful triangle. If you look at long-term gold, it has formed a beautiful triangle, and it's also between the April, May, and June daily, if you look at just gold on daily, has formed the perfect head and shoulders pattern. So this is telling us something very specific about gold. Okay, and I believe gold took a serious breakdown today. Okay, so yes, it had to do with the Feds, but everybody was calculating already in their buying and selling of gold what the Feds were going to do in June. Okay, symmetrical triangles occur when two trend lines converge towards each other and signal only that a breakout is likely to occur. Now remember, a breakout can be a breakout as a confirmation, or it can be a breakout as a reversal. Okay. And so they don't tell you what the direction will be. You'll know the point that you should see it because you'll see everything getting congested into that triangle. Ascending triangles are characterized by flat upper trend lines and rising lower trend lines. Okay. Now, the magnitude of a breakout or breakdowns is typically the same as the height of the left vertical side of the triangle. So in other words, when you see this is the left vertical side, so this is the magnitude. So when we have the actual breakdown or the breakdown, we would expect it to equal that point. Okay. So a symmetrical triangle strategy is one of that is simple and effective enough to let you gain from momentum without staying a second longer than necessary. The strategy relies on a pattern that, no surprise, is called the symmetrical triangle. And symmetrical triangle strategy is a great way to trade, because when you're in the market looking at a reversal or a retracement, and you see the price moving into the symmetrical triangle, when you see price moving into the symmetrical triangle, okay, you can then apply that to an entire trading strategy. I always like to say that in any trading strategy should only be exposed to the market when absolutely necessary. That is, whether it's a strategy running on daily intervals or monthly intervals, a trader should not stay in the market longer than needed because it leaves room for the unexpected. Okay. This is especially true when it comes to momentum strategies, and it can be the difference between gain and pain. The symmetrical triangle strategy is one that is simple and effective enough to let you gain from the momentum without staying a second longer than necessary. The strategy relies on a pattern that, no surprise, is called the symmetrical triangle, which will help you predict breakouts and breakdowns, or continuations and reversals. Okay. So what is the symmetrical triangle pattern? Simply put, it is a pattern that enables you to buy into a correction and sell before the pair break peaks again. In order to identify a symmetrical triangle pattern, we have to watch for 4 unique yet symbiotic conditions. The pair has to be in a long-term bullish trend. Okay. So we're looking for an asset that is moving up in a solid, good trend. In other words, thrusts and ease, thrusts and ease. It's a nice long trend. Okay, it's not a weak trend. It is not a very short-term trend. The pair has to be in the midst of a temporary correction. What is a temporary correction? A retracement. The correction has to be in the shape of a triangle with lower highs. Okay. So what do we have? Okay. We have our trend line. We have our long-term trend. We have price easing down. When it bounces back up, it's making lower highs. Remember, we talked about that earlier. Okay. We don't know when it's going to make that higher high or if it's going to reverse down. So we're looking at this here as it is making that retracement. So we've got a longer term trend. We're in the midst of a correction, which is a retracement. And the correction has to be in the shape of a triangle with lower highs. So what do you have? You have the resistance line touched here, right here. Price goes down into its retracement. It's making lower highs and continue down. When you can draw a line between down there, what do you have? You have one part of your triangle. When you draw your support line down here, you have your base of your triangle, and then you have your left vertical side. So you formed a triangle. The momentum of the correction has to converge with the oscillator as seen in the MACD chart below. So what we're doing is we're combining this with MACD, and we're also seeing the same pattern develop in a MACD, and we're getting a convergence in the MACD histogram and the MACD between the MACD line and the moving average line, and it's giving us an entry point. So what it's telling us is to enter the market here, okay, and we would look for the correction at that point to be equal to the vertical line. And this is called a symmetrical triangle trading strategy. Okay, the buy signal comes at a very specific time. That is after the pair breaks the correction pattern, or the retracement is confirmed and it moves back up, and the oscillator, and my case is I always use MACD, moves back above the zero and ascends into buy territory. In other words, you got the convergence. The symmetry of the triangle is what helps us determine our limit. The symmetry does not have to come in the shape of a symmetrical triangle in an upward move. In fact, the only one element should be symmetrical, the highs. The highs from where the price breaks the correction pattern should be identical to the highs of the triangle. Using the grid to measure the height, if the height of our triangle is 3 and 3.5 square, we should stretch point A to 3.5 squares to point B. So in other words, this is our A, this is our B, this is our A. Okay, so this is 3.5, and then we have our B. Okay. Now, this is a well-known strategy. This isn't the secret strategy I'm teaching you. So if you want to read this step by step, just go search on the internet, go to Symmetrical Triangle Strategy, and you'll find it. It's a well-known strategy, and it'll explain to you in great detail how to use the grids and how to multiply, because this will help you with your entry point and your exit point. The chart shows that the pair has continued above point B, which was our target. Yet the symmetry rule made us exit the trade early. Why? The idea is that when you have a triangle break that fulfilled a aforementioned condition, it tends to generate a move higher, at least the same height as the triangle from the point of the break. If, for example, the bullish trend would have been over, the pair would have topped out a little above the point B. Now, this all is a little crazy, but what it says is, okay, you're saying, why did I get out of the market when the uptrend continued? The fact is, when you enter a market, you should always have a target point. You can calculate your target point using the triangle. Now, if you decide to stay in, this is when you get greedy and foolhardy. When you decide what your target point is, you take profit, or where you're happy with the reward for the day, okay, you exit the market at that point, because the rule is stay in the market for a shorter period of time and make the most profit. Okay. When you start breaking your rules, and your trading plan should always have your entry point, your exit point, your stop loss point, your take profit, and then you should be calculating your risk to reward ratio and determining whether you make the trade and how much you're going to invest in that trade. And those rules are written on paper before you start, and that's what you follow. You don't change it, you don't adjust it because you get greedy. So when we add the entry methodology that allows us to enter the trade early with minimal risk, the picture becomes clear. The symmetrical triangle is an in-out quick strategy that minimizes risk in both directions. The entry is right after the bottom of the correction, and the exit point is distant enough to make it a worthwhile trade and quick enough to avoid a potential trend reversal. But before you start, of course, as with any strategy, including the symmetrical triangle, there is no singular perfect strategy that can always guarantee profit. Okay. But to trade retracements and reversals, it is one of the easiest strategies to apply. Or you can just apply it while you're using other things to trade, not as your strategy, but as your explanation as to whether you're in a retracement or a continuation. For example, the waves that followed, we can see that there was no lower tops when the pair corrected, just a steep descent towards the support line. That means that a symmetrical triangle is in a low frequency strategy. It provides an entry signal every once in a while. Naturally, this means you cannot rely on the strategy alone for profits because it may take time between each opportunity. But when balanced with other strategies, the symmetrical triangle can certainly spice up your results and allow you to improve your trading performance each time it produces a burst of momentum. Okay. Now, while I was researching this class, I came across this funny one called a sushi roll. And we're not going to spend much time into it, but I just thought it was cute. And it is all about buying and selling the retracements and the reversals. Okay. It's a 10-bar period where the first 5 bars are confined within a narrow range of highs and lows, and the second 5 bars engulf the first with both a higher high and a lower low. So it's each time that the asset moves up over 10 bars and then thrusts back down and eases down, you would buy at the bottom of the 10 bars, sell at the top, and buy again. And it's like rolling up a sushi. Okay, when the sushi pattern shows up in a downtrend, it warns you of a possible trend reversal, showing that it's a good time to look to buy, or at the very least exit a short position. If it occurs during an uptrend, the traders get ready to sell. Okay. While Fisher, who's the guy who developed this sushi strategy, discusses 5-bar patterns, the number of durations of bars is not set in stone. The trick is to identify a pattern consisting of both the number of inside and outside bars, like inside rolls and outside rolls of sushi. Okay. Now, the second trend reversal pattern is for the long-term trader, and it's called the outside reversal week, because in a sushi roll, except that it uses a daily data starting on a Monday and ends on a Friday. It's just a crazy trading scheme. And I think I used it more to show you how weird and how wacko these people come up with these strategies and publish them. And before you know it, they got people trading them and they make absolutely no sense. Okay. But remember, keep calm, decide what you're going to do, plan it out, stick to your rules. But reversals and retracements can be critical in helping you to make sure you maximize your reward while minimizing your risk, and know what you're looking at so you know, I should hit and run and get out of the markets, or I stay in the market because I don't want to panic and sell too soon. So remember, deal with the charts, understand what false signals are, know what your support and resistance levels are, and realize that it is a healthy trend that makes retracements. So in conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on to losing position, losing money, and wasting money on commissions and spreads. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. And on that note, I'm going to say goodnight to you. I again apologize for the lack of electricity and the weak internet because, like I said, I'm using the internet from across the street where they still have power, and without power you don't have modems, and without modems you don't have internet connection. So I do apologize for that, but I think the class went fairly well. And we'll see you again real soon. The class was recorded, so after about 24 hours, you will be able to see it by using the same link that you used to attend the class tonight. So have a good night, and thank you very much for supporting Prime and also for being part of the Investing.com family. Good night now.